Welcome back, traders, and happy new year. We're back with more technical analysis as 2026 started with fresh geopolitical tensions. During the weekend, US military forces unexpectedly captured Venezuela's President Nicolas Maduro over drug-related charges and perhaps disputes involving oil, bringing safe haven metals back on the spotlight. Meanwhile, euro-dollar and dollar-yen might be key FX pairs to watch later this week, as the calendar includes Eurozone's flash CPI inflation figures due on Wednesday, as well as US non-farm payrolls out on Friday. So let's start our analysis with gold first, and looking at the price, we can see that it's has resumed its positive momentum. It even printed a new intraday high near 4,439. And that comes after the US military forces unexpectedly captured Venezuela's president, which consequently increased the concerns about President Trump's authoritarian political stance and even increased risks for future military actions by the US in other countries. So that basically geopolitical risk may keep supporting gold if more geopolitical episodes emerge later this year, and that has helped the precious metal to keep its support around its 20-day moving average, just around the 4,335 level. A rise above the previous high of 4,380 may also keep buying sentiment in play, and if we successfully break above the 4,445 zone, which was kind of restrictive just before Christmas, we can see the price even rising up to the 4,550 and 46 territory, where this key resistance trend line is placed. Then above that, the rally could stretch towards the 161.8% Fibonacci extension level of this downfall that happened late in October, and even the price could reach this longer-term resistance line, which connects the highs from April 2025 and October 2025, just around the 4,765 zone, and the 4,800 psychological mark could also come inside in this case. Well, looking at the technical indicators, we can see that the short-term bias is still positive. The RSI has just rebounded, actually has strengthened within the positive territory above 50. The stochastic oscillator is also set for a rebound, so that increases the risks for more upside moves. Nevertheless, if the price fails to close above 4,380, and more importantly, if it pulls back below the 20-day moving average, we can see the price falling towards the support trend line seen near 4,235, and even testing the 50-day moving average, which is currently flattening just around the 4,177 territory. Any declines lower than this territory may bring immediately the 4,000 psychological mark back into play. Now switching to dollar yen, we're expecting US non-farm payrolls to come out normally on Friday. Forecast suggests for a moderate increase of 55,000 increase in employment. The unemployment rate may slow down to 4.5% from 4.6% previously, and average hourly earnings may edge slightly higher, which could be overall a positive report if that proves to be the case. Nevertheless, if employment growth continues to rise at double digits, perhaps that could be still a cautious sign about the strength of the US labor market. Nevertheless, such a report may not be able to trigger, may not be able to call for an immediate rate cut. Of course, any negative surprises could do that, could still could still increase the odds for a 25 basis point rate cut as soon as in January. However, if the data keep the current trend, yeah, that could be less likely. Looking at dollar yen though, we can see that the US dollar is still quite resilient, is still holding just around its recent highs, near 100, above 157. The price peaked at 157.88 back in November, and it also peaked just around the same level in mid-December. So that territory might be quite important, around 157.70. If we successfully breach that, we could head as high as 158.90 and even approach the 160 territory. Taken from 1990s and even from 1980s. Those were key barriers back then. Then the 161 psychological mark could be the next target before we fight for a stretch towards this resistance line near 162.50. While looking at the technical indicators though, we can't see actually a strong bullish bias yet. The RSI, even though it's above 50, it keeps flatlining above that level. The stochastic oscillator is also very close to 80 despite rising, so that suggests that perhaps some caution remains in the market, particularly as the Bank of Japan prepares to further raise interest rates. And of course, any significant spikes in dollar yen could also cause some FX intervention from Japan. So that keeps trading the cautious mode and looking to the downside for support levels. We can say that the market is still supported above its 20 and 50-day moving averages at 156.12 and 155.35. The 155 and 154.34 zone, 35 zone could be also a key territory that could ease selling pressures. However, any declines below this territory at 154.35 could activate first selling, sending the price towards the 153 level, which coincides with the 38.2% Fibonacci retracement level of this up leg. Then below that, the 151.50, which represents the 50% Fibonacci mark, could come next into view. And finally, looking at euro dollar and Eurozone CPI inflation figures, which are due later this week on Wednesday. Expectations suggest for a mild slowdown to 2%. That's exactly where the ECB's price target is, and the core measure could also remain quite close to that target at 2.4%. So overall, the data may not cause any concerns if forecasts prove to be correct. But given that rate hike speculations over a rate hike have been actually creating headlines lately, it will be quite interesting to see if the data, if any surprises in the data can actually cause divisions within the board, within the ECB board, after the ECB's president Christine Lagarde left the door open to all options. Nevertheless, in the meantime, we can see that euro dollar is weakening it's extending actually its pre-Christmas downfall, and it has reached a new low at 1.1670. That's the lowest since December 10th, and that's actually a new lower low in the short-term picture, which happened just below the support trend line, and that increases the risk for more downside. And looking at the technical indicators, we can see that the risk is shifting to the downside. We can see the RSI is now set to move below 50. The stochastic oscillator is within the oversold zone, but it keeps falling, and the MACD continues to decelerate below its red signal line. So it seems that downside risks are more than upside ones, particularly after the break below the 20-day moving average. And whether more declines could emerge, that may depend on the 1.1670, 1.1685 zone, which was also a previous constraining zone. The 50-day moving average is also very close at 1.1637, so that could also ease downside movements, protect the market against an extension towards the 200-day moving average, and especially if the price also closes below 1.1590, which is a strong barrier against downside movements in previous months. Now, in the event upside pressures emerge, in the event that US inflation actually cause concerns that perhaps more inflation could emerge, euro dollar may reverse to the upside, and if it manages to close back above the 20-day moving average at 1.1725, we could see another key battle just between 1.1790 and 1.18, which the price failed to successfully claim back at the end of December. If the price manages to overcome this wall, then a rally could happen towards the 1.1865 zone, which also the bulls couldn't successfully surpass back in September. And then if the rally continues, the 1.19 level could be the next target, while higher than that, the 1.1970 might be another key barrier to watch. It has been a key obstacle against upside movements a couple of years ago. So that's everything I wanted to share, guys. This is the end of my video analysis. Thank you for watching. If you would like to read more about XM's technical analysis reports, you can always follow the link below to subscribe and also to join our fresh technical updates. So that's everything from me. Thank you for watching and see you next time. Bye bye for now.